I'm Andrew Freeman with Freeman Meyer Real Estate. I'm going to talk today a little bit, the panel's talked about the economic environment and sort of what's going on in the market right now. I think it's a very good time to be considering buying commercial real estate. Vacancy rates in our little bubble of Boulder are low. They're under, for the most part, under 10%. Lease rates are low. Which means the combination of a low vacancy and low lease rates allows for buying properties generally at lower prices, and that's a good thing. One disclosure is my professor from DU, the finance professor here? Okay, good. All right. I'm going to talk today about two financial terms that I think I spent 3 semesters in college trying to understand, and I think I finally figured it out about 20 years later. But the first one is capitalization rate, and the second one is cash-on-cash return. And these are really two tools that are used to value real estate. So when you're sitting with your clients, and you see a commercial condo and it's $300 a square foot, or it's $100 and building's $100 a square foot, is it a good deal? Is it not a good deal? Well, really to determine if it's a good deal or not, these are the tools that you can try to use to figure that out. So cap rate, just if you're unfamiliar with the definition, is net rent divided by the purchase price. So net rent being gross rent, which is the base rent, the triple net expenses, basically everything that a landlord's going to collect. You subtract out the operating expenses, which are the real estate taxes, the insurance, the common area maintenance, but it's before debt service. So that's your net rent. So you divide that by a purchase price and you get a cap rate. So very basic example, if you have a building where the net rent is $100,000 and the purchase price is $1 million, you divide 100 by 1 million, you get 10%, your cap rate's 10%. So how does that determine value? For leased buildings, if you have 2 buildings that are next to each other in the same market, built at the same time, basically the same structure, generally look and say they must be worth the same thing, but depending on how they are leased, they can have 2 dramatically different values. So from a cap rate standpoint, if you're looking at a building that's leased to, say, a Walgreens, who's considered a credit tenant, a strong tenant, they're probably not going to go out of business anytime soon, you can count that they're going to be there, that is going to be worth more than, say, a property, and I used maybe I shouldn't, the MMJ industry, but I don't know, maybe that's a better credit than Walgreens these days. But in this example, a 10-year lease, Walgreens, the market dictates the cap rate, just like it's going to dictate the value of tenants are going to dictate the value of a rental rate. People are buying houses are going to dictate the value of what house prices will be. So investors basically dictate what capitalization rates will be. Right now, for a Walgreens, an investor is going to be willing to take less of a return for the security of having a Walgreens and a 10-year lease in the property. So if you divide the 0.07 or 7% into their rental rate, then the property value for that Walgreens is $1,040,000. In turn, if you look at the same building and it's a 3-year lease, leased to a tenant that maybe doesn't have the same financials, there's more risk. They can go out of business, the lease is coming up sooner, there's more potential costs on that type of transaction. So I went extreme, you could say the cap rate on that is much higher, meaning that an investor is going to want a higher return to buy that same property, thus they need to buy it at a lower price. So you take the 0.14, divide it by 100,000, you get 715,000. So there's 2 same building, same structure, same date that it was built, but there's 2 very different values based on the lease income. So major ingredients when you're evaluating a property, even if you're a user. For the most part, the transactions we deal with, we get involved with, Audrey touched on it a little bit, companies will set up, individuals in a company will set up their own LLC. buy the property in the LLC and lease the building to the company that they own. And so regardless if you're just an investor looking for leased property or you're a user considering investing in a property, the key ingredients are the rental rate, credit of the tenant, length of lease, and then the quality of the building. So the second tool that we use a lot is cash-on-cash return. And the definition is cash flow divided by your down payment or the equity of the property. So your cash flow or your cash-on-cash return is similar to interest that you're getting on a money market. Really, it's the same thing. So in this example, you take the same gross rent, you subtract out the operating expenses, but you also subtract out everything else, including your debt service. And at the end of the day, you hopefully there's cash flow there, and that's your cash flow. So in an example of a deal, same thing before, if you have a building where the net rent is $100,000 and the debt service is $60,000, your cash flow is $40,000. What I didn't include in this example, there's a lot of other things you throw into deductions. Expected vacancy, tenant improvement costs, leasing commissions, you need to replace the roof. So really in a real life example, that $40,000 based on the assumptions you put in there would probably be a bit lower or a lot lower. But in this example, if you're buying a building and it has $100,000 in net rent, debt service of $60,000, your cash flow is $40,000, your down payment's $250,000, then your cash-on-cash return or your $40,000 you're getting from the $250,000 you put in is 16%. Very high. Generally right now we're looking at cash-on-cash returns for a typical project maybe between 8 and 10%. If you get that, that's great. Obviously compared to a money market at 1.19%, you know, it's fantastic. Obviously less liquid. So in an example of kind of what I'm talking about here is about 7 years ago I represented a company by the name of American Coin Merchandising, Inc. If you ever go into a Walmart or a Costco and you see those games, the skill crane games where you put $1 in and the thing comes down and you try to get an animal out and you never win, and, that's what they do, and they do it pretty well. And so they needed they were in Flatiron Park, they were looking for about 25 to 30,000 square feet. The 3 executives of the company wanted to form a partnership to own the property. So we put together a group with the 3 executives, with myself, and actually this building that we purchased was a new building, but it hadn't been built out inside. So we actually brought in Quinlan Construction. Don Quinlan came in also as a partner, did the construction. So for this project, it was sort of a mix of, when we're talking about, you know, a lease compared to purchase, we were almost somewhat combined it, where again we formed the executive team to form this LLC. We put together a 10-year lease with the company at a market rental rate, built out the space for them, bought the property, put together the operating agreement, and now 6-7 years later, actually all of the executives no longer work at the company. Our LLC is still intact. We're earning about a 13-14% cash-on-cash return, and we've paid down debt for the last 7 years. And this is in Louisville, so we're very much hoping that ConocoPhillips moves in about a mile from this building a couple of years down the road, which will also help with the value. I think that's it.